IFRS 13 Fair Value Measurement establishes a single comprehensive framework for measuring fair value across various IFRS accounting standards. Before IFRS 13, different standards contained inconsistent definitions and guidance regarding fair value measurement, reducing comparability and clarity within financial reporting. IFRS 13 standardizes the concept by defining fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The standard focuses on market-based measurement rather than entity-specific intentions or values. Fair value measurement is widely applied in areas such as financial instruments, investment properties, biological assets, business combinations, and impairment testing. Accurate fair value measurement enhances transparency, comparability, and relevance in international financial reporting. A key principle of IFRS 13 is that fair value should reflect assumptions that market participants would use when pricing assets or liabilities. The measurement assumes an orderly transaction occurring under current market conditions rather than forced or distressed sales. Fair value is determined from the perspective of market participants who are independent, knowledgeable, and willing to engage in the transaction. For non-financial assets, measurement also considers the asset's highest and best use, meaning the use that maximizes economic value either individually or in combination with other assets. This principle ensures that fair value reflects realistic market expectations rather than management intentions, thereby improving the reliability and consistency of financial information presented to investors and stakeholders. IFRS 13 requires entities to identify the principal market for the asset or liability, or in the absence of a principal market, the most advantageous market available. The principal market is the market with the greatest volume and level of activity for the item being measured. Fair value measurement should maximize the use of observable market inputs and minimize reliance on unobservable assumptions. Observable inputs include quoted prices, interest rates, yield curves, and market transactions, while unobservable inputs involve internal estimates and assumptions. The standard emphasizes market evidence wherever possible because market-based data generally provides more objective and verifiable information. Proper market identification ensures that fair value measurements reflect actual economic conditions affecting asset and liability valuation within international markets. To improve consistency and comparability, IFRS 13 establishes a three-level fair value hierarchy based on the observability of valuation inputs. Level 1 inputs consist of quoted prices in active markets for identical assets or liabilities and provide the most reliable evidence of fair value. Level 2 inputs include observable data other than quoted prices, such as prices for similar assets, market interest rates, or yield curves. Level 3 inputs rely on unobservable assumptions and internal valuation models when market information is unavailable. Entities must prioritize higher-level inputs whenever possible. The hierarchy enhances transparency by helping financial statement users evaluate the reliability and subjectivity associated with fair value measurements presented within financial reports. Selecting an appropriate fair value measurement requires consideration of the nature of the asset or liability and the availability of market information. IFRS 13 identifies three widely used valuation approaches: the market approach, income approach, and cost approach. The market approach uses prices and information from comparable market transactions. The income approach converts future amounts, such as cash flows or earnings, into present values using discounting techniques. The cost approach reflects the current replacement cost of an asset adjusted for depreciation or obsolescence. Entities may use one or multiple valuation techniques depending on circumstances. Appropriate selection ensures that fair value measurements represent realistic economic values and provide meaningful information to investors and financial statement users. Fair value measurement also applies to liabilities and an entity's own equity instruments. When measuring liabilities, IFRS 13 assumes the obligation is transferred rather than settled, and the liability remains outstanding after transfer. The measurement therefore reflects non-performance risk, including the entity's own credit risk. For assets and liabilities managed together, such as financial instrument portfolios, fair value may consider net exposure to market or credit risks if certain conditions are satisfied. The standard additionally requires extensive disclosures regarding valuation techniques, assumptions, hierarchy levels, and sensitivity analyses for Level 3 measurements. These disclosure requirements enhance transparency and allow stakeholders to assess the uncertainty and reliability associated with fair value estimates used in financial reporting. Overall, IFRS 13 provides a unified and principles-based framework for fair value measurement across international financial reporting standards. By emphasizing market participant assumptions, observable inputs, orderly transactions, and transparent valuation methodologies, the standard improves consistency and comparability in financial statements. The fair value hierarchy and disclosure requirements further strengthen transparency by enabling users to evaluate the reliability and subjectivity of valuation estimates. Fair value measurement plays a critical role in modern accounting because it affects financial instruments, investment properties, business combinations, biological assets, and impairment testing. For DIP IFR candidates, understanding IFRS 13 is essential because fair value principles influence many areas of IFRS accounting standards and require both technical expertise and professional judgment in practical application.